Hello and welcome to the Property Trio podcast. As always, I'm joined by Cate and Mike. How are you both today?
Really good, Dave. How are you going?
Very, very well, thanks. Actually been putting a lot of work into our podcast that'll go live next week, our listener question for Alex and his partner who have two investment properties and planning whether they should buy the family home, sell one, sell two. The team have been putting in a heap of work analysing the numbers and trying to work through their scenarios. And I know you have been as well, Cate.
Oh, I've had a little look at the suburbs that they're in and what some of their options are like. We love the juicy listener questions, and it does keep us busy, but we want to give really good general advice, and so that means going deep down into all of the various options that we think they could have. So, yeah, Alex, this one next week is for you.
You guys really do look after the listeners. The might of property planning and Cate Baker's Buyer's Agent of the Year, insert year here. I can't remember which one it was. But yeah, people are pretty lucky to have you guys as heavy hitters looking at their scenarios.
Yeah, well, we've just got to put the call out. We want a few more QS related requests, and we can
get me working.
Get you sitting over the calculator.
Yeah. Yeah. But this week's episode is close to both of your hearts, as two of PIPA's, which is the Property Investment Professionals of Australia board members. You are both familiar with these interesting findings that we're going to go through, which is the PIPA Investor Survey Report findings. So each year, PIPA produces their annual investor sentiment survey after going out to investors and industry professionals. And it provides some wonderful insights into investor sentiment, what they're thinking and planning for the year ahead. So this year marks the 11th year of the survey. And we've found some pretty startling outcomes this year. So, Cate, can you take us through some of the findings?
Yeah, of course. Australia's rental market is under mounting pressure, as we all know, as a record number of property investors are exiting the sector. Particularly, we've felt this in Victoria, but we're not the only state. And this change with investor-led sales is driven by rising costs it's driven by rising costs, primarily heightened interest costs, but also a lot of maintenance costs and taxes and all kinds of other things, legislative uncertainty, and concerns over proposed federal tax reforms. So it's been interesting to see how investors have reacted to these things that have been front and centre over the last year or so. Now, the 2025 annual property survey shows that 16.7% of investors sold at least one property in the past year. So this is not about what people are thinking or wanting to do. This is what they did. And that's up from 14.1% last year and 12.1% in 2023. So that's a really significant upward shift in the number of people who have sold an investment property. This marks the highest rate of investor sales since the question was first introduced, and it highlights a clear and escalating trend that threatens rental housing supply nationwide, because as we're seeing these investor-led sales, they're not all selling to investors. So our rental pool is depleting.
So I won't ask the rhetorical question, but we've been talking about investor-led sales for a while now. And the impact it has on rental availability and pushing up rental prices. So clearly the survey is showing this sentiment. Why don't we unpack this a bit further, Mike? Is it just Victoria that is in decline, or is Victoria even in decline?
No, I mean, it's not just a Victorian problem. Obviously, it's had the lion's share of press in and around the land tax issues, but Brisbane had its own land tax issues as well. So the survey did circle Brisbane, but unlike the previous year when it was dealing with the land tax issue, which was repealed, and also the high penalties for Airbnb investors in Queensland, the number of investor-led sales in Brisbane did decline. The number was still high, though, at 19.6%. 22.7%, but the previous year saw 26.1% of investors selling, which was absolutely massive. That compares with Melbourne at 22.1 versus 22.7 last year. Those two cities aren't the only ones to note with investor-led sales, though. Perth did see an 11% print of investors selling. Not entirely surprising given the price gains on offer, though, so people perhaps locking in some of those gains.
Yeah, so that's interesting, Mike. Kate, what did you make of some of these numbers?
Yeah, Mike's right. I mean, the Perth investors are cashing out. Not all of them, but those that have sat there for over a decade watching their property go backwards or sit static. Finally they can go past, from a psychological point of view, go past that awkward milestone, breathe a sigh of relief, and know that they've finally got a gain. And for some people, it's that sense of not willing to admit defeat, and you're waiting for the poker machine to finally pay out. I think a lot of people in Perth did that. Now, in saying that, I'd argue that for many, the lost opportunity outweighed the recent gains. And if we model the longer-term performance of the capital cities, Perth wasn't the long-term standout. It's only really delivered again in recent years. And I think we need to recognise, though, that the short-term gains are so appealing to those investors who either like to jump around and sort of trade in property, or those who have a genuine need for getting their funds out of a hot market. Perhaps they're retiring debt. Maybe they're switching from investing and focusing on a home upgrade. There would have been reasons for Perth people saying, let's sell, because the market's been really strong, and it still is. Queensland's gains would certainly be rewarding plenty of investors, and as we know, many investors do like to crystallise a gain.
Yeah, so we've mentioned Melbourne, Brisbane and Perth. What about some of the regions? Did the survey capture that?
Yeah, indeed it did. The story's just as intriguing. Regional Queensland sat at the top of the pops with 15.8% of investors selling, more than doubling last year's figure. That's huge. Regional Vic followed at 7.9%, while regional New South Wales investor-led sales fell to 5.51% after 10.5% last year. And that is a significant change. I've pondered some of those reasons. I suspect interest rate cuts helped keep investors calm in New South Wales, while perceived gains in Queensland would have stimulated that market, much like Brisbane and Perth.
It certainly suggests that turnover of investment properties is much lower in regions. So they're much more stable markets than the capital cities.
Yeah.
So
absolutely.
let's talk. Yeah. Do you have any take on that, Mike?
Look, I think we shared maybe a couple of months ago the point of the cycle where we were sort of tracking regional prices versus capital cities, and they have been performing pretty well. I think if you look at the index of regions to capitals, I think it's around about 1.2, whereas it gets to 1.6, 1.7 quite broad. So those markets have been fairly good, fairly resilient, and I still think in some respects we are seeing the unwinding of the COVID, CBD type jobs. It kind of feels like that was a flash in the pan thing that's gone away. But a lot of these companies have, 10-year leases within buildings as well. So I still see we're kind of maybe seeing that roll away, and the regions are the beneficiaries of that. Not just that, but the price points, the yields, especially when we're talking back when we were in more of a higher interest rate environment.
Yeah, I think they're probably easy to hold on to, generally speaking, because the median prices are lower, so the debts are lower, and the yields tend to be higher. So there probably is a lower turnover generally as well. So let's talk about who bought these investment properties. Mike, did the survey shed any light on this?
Yeah, it did. So 42% of the past year's properties were purchased by other investors. So a notable jump from 31% of investor sales being repurchased by investors, and just 24% in 2023. But the remainder were absorbed by first home buyers. Now, of course, it's great that we're seeing first home buyers getting into the market, but it raises a concern about the depletion of properties from the rental pool. We've recently seen an uptick in rental rental growth again after, the huge increases that we saw through 22, 23, 24. We've definitely talked about that before in a number of market updates. That's impacting inflation. But of course, from a property specific point of view, the impact of this is fewer homes available for tenants and increased pressure on rental affordability.
Yeah, so circling back, the reasons why we've seen investor-led sales increase. Kate, can you please talk us through what the survey polled as reasons for this?
Yeah, the majority of sellers were seasoned investors who held their property for at least 5 years, which is really interesting. The most common tenure being 10 to 20 years. So 30.7% of people who sold had held their property for between 1 and 2 decades. And then 29.1% had held their property between 3 and 7 years, and 20.5% had held between 7 and 10 years. So we're not talking about people that have just held their property, for a couple of years and have been really sensitive and disappointed with it. All these are long-term investors. I mean, nearly a third have clocked up to 2 decades. So they've seen interest rate cycles, they've seen challenges, and still they've made a decision to sell. This set of stats, it did catch me by surprise, and I didn't think investors who had held for that long would be so sensitive to changing conditions. But there will be other reasons for that, of course. The first is cash flow versus capital, and the classic saying when you're cash flow rich and cash poor, or cash rich and cash flow poor. And, retirement planning and would have been a big driver of this as well, because if someone's held a property for 20 years, we've got to assume that they've got a bit more age on them than a young investor, and they might be approaching retirement. Also, as you get closer to retirement, or once you've stopped acquiring properties and you no longer need the benefit of leverage, you might be looking at changing asset classes and going into shares. And, I laugh about this when I get annoyed with my own property portfolio, but shares don't have, hot water services blowing, and shares don't have land tax bills. There's a lot of advantage there to switching asset classes, and a lot of people do it. And when you've got added costs and holding costs or interest costs or whatever, that's when people will take the opportunity to look around them and make that switch. I think a distinct frustration with the onerous rental reforms is a really big one, though. And the reasons cited in the survey, because respondents did tell us why, in order of reasons. First was reducing debt exposure. Second one was rising general holding costs and compliance costs, including insurance, property manager fees, and also the cost of maintaining minimum standards, which in some states have increased markedly. Another one is policy uncertainty. It's a growing threat, and the survey touched on the threat of both negative gearing changes, to which 53% said they'd stop property investing if there were changes to negative gearing, and similarly capital gains tax reductions. That could spook respondents, because 35% suggested they'd exit the market if the 50% CGT discount was changed to 25%. Now, again, this is sentiment. People are saying what they'd do, and we find that doesn't always necessarily translate, but they're pretty compelling reasons, I think. And the fact that investors had to nominate their reasons gave us some really valuable insight.
Yeah, look, I certainly think there's some concern out there in the property investor space, if you like, about what the government might do with reducing capital gains tax and even limiting negative gearing over time. So, that absolutely has the potential to spook those who are considering buying an investment property. In regards to this, Mike, were there any other policy-related sensitivities that were picked up in the survey?
Yeah, definitely. And just to highlight the point that Kate made, we've got, people 55 years and over now accounting for 21% of the population. And if we look at, say, 65 and over, in the 2020s, it's around 16% of the population. You go back 10 years and it's more like 14 or 15%. That doesn't sound like a big number, but we're talking a fairly big cohort of people. So that factors in. But yeah, I also kind of think that when people who are investing in a property for 10 or 20 years, they don't like the idea of the rug being pulled from them. I think investors like certainty, and that kind of came up in the survey. One of the big concerns was a lack of clear communication from state governments on tenancy reforms, and there's been quite a lot, and the knowledge about these reforms I kind of thought was quite there because I'm dealing with people within the industry, but when it comes to the investor, they're a little bit in the dark. So remarkably, 64% of respondents were unaware of Victoria's new vacant residential land tax, and 60% admitted to having only a moderate or limited understanding of tenancy law changes nationwide. Even more concerning than that, 10% reported that they'd never received any communication from their state or territory governments on these reforms, despite being investment property owners. The gap highlights more than just policy shortcomings, though. It reflects a failure of engagement. Investors are being asked to navigate these increasingly complex regulations with next to no guidance or support from governments, and the consequences we can see are unfolding in real time.
Yeah, that's just shows how uninformed a lot of property investors are about these changes, doesn't it? And
it does. And if you talk to property managers, that they've really had to drill down into the detail, in legislative updates to really get a grip on how to advise their clientele, which is landlords, and then how to talk to their customers, which are tenants. And I don't think that it should be that hard. And yet when you look at some of the legislations, it's not always clear. And there's a lot of surprises for property managers as well.
Yeah, and as I think we've seen anecdotally, but also Mike's business's analysis has shown, people are buying interstate more often, so across various states, borderless investing. So that means they have more government, state-based government policies and changes to stay across. So, you can see why that would feel quite complex and hard to start to speed with for many investors.
Yeah.
Cate, did the survey? We've covered a lot of sort of challenging aspects of being an investor. What about some positive signs?
Yeah, we did have some positivity. It wasn't all doom and gloom. Confidence is up. And that's a great thing in our space anyway. Nearly 60% of all investors surveyed believe that the next 12 months is a good time to invest in residential property, up from 45.7% last year and approaching the 62% recorded in 2021. Now, if we cast our minds back to 21, interest rates, our cash rate was at 0.1%, and people were going gangbusters with buying. So that's quite incredible, seeing
really
that swing
positive.
to almost at those levels. And I'm certainly experiencing that here in my business. We're talking to investors every single day, and I haven't seen this many investors in a long, long time. So surprisingly, despite our economic woes and our rental doom and gloom, it's Melbourne leading as the preferred investment destination. A whopping 41% of survey respondents suggested Melbourne was the best place to buy. What a pivot from last year's 26.3%. And as we've noted in our market updates, Brisbane held steady while Perth dropped to 9.2%, down from 25.2% in 2023. Now, another surprise for me was that of Darwin. And I'm trying to work this out. Only 2% of respondents nominated Darwin as their preferred investment destination. Yet that really clashes with the figures we've been seeing when we have our market updates. And all I can think is that the sheer size of the city, which it's a small city in contrast to all of the others, and the reaction that a city of this size would have to a rush of buyers is showing all of those really strong gains, because you don't need many people to move a small market. So while we've got a survey
100%.
suggesting, that was all I could put it down to.
Has
Would
to
it be delays?
I think.
Because Yeah, this was in real time. I mean, our survey finished and then surprise, PIPA, and, big congrats to Bricks and Mortar who pulled data all together and had this amazing set of graphics here. We were able to look at the data and really see it in real time within just a matter of, I think, less than 2 weeks. And while I'm talking about that, this is a document that we can share with our listeners. We've been giving away a few things each week in the last couple of weeks, but if you'd like a copy of the PIPA Investor Sentiment Survey, please just send us an email or click on the link. I'll bury that in the show notes as well so that you can get a copy for yourselves.
Yeah, great. Yeah, it's a really low number, isn't it? But I guess it's population proportionately. When you combine all the capital cities' populations, it's probably not far off only being 2% of the total population. So Darwin's probably just not on the radar for a lot of people, but it's obviously on the radar for enough people that it's had the boom it's had, isn't it? But that's really interesting that the 41% of respondents suggested Melbourne was the best place to buy. That is out in front by a long way. So, yeah, it's going to be really interesting to see how the capital city markets continue to play out well, there's not much left of 2025, but particularly 2026. And if we get another rate reduction, whether it's late this year or early next year, as I've thought 2026 is going to be a bit of a moving year with the property markets. We're coming to the end of this episode, but Mike, the survey has certainly captured some important details, some surprising, some not so much. But what was the key takeaway for you?
Oh, look, I don't know if there's one particular key takeaway, but there's a few bits and bobs. The people that were reporting that they were positively or negatively or neutrally geared was interesting. I think we were talking sort of mid-50s were negatively geared, whereas the ATO data is probably saying it's closer to 2/3. And interestingly, 2% of people were unsure. If you're one of those 2% people who don't actually know, I recommend you speak to someone to try and work that out, because as we sort of talk all the time, planning is really important. One thing that I wanted to zero in on that I suppose I'm a little bit sick of hearing is that when the cost to hold an investment property increases, there's this assumption from especially tenants unions that landlords just pass on all of the costs, but 65% of respondents said that they passed on less than 10% of their increased operational costs. So that I feel like is a very, very meaningful number that we would do well to understand. But yeah, just so much in this particular survey.
It's fake news, isn't it?
Yeah, exactly.
You can't just pass on the costs.
I know. I mean, it's worth a shot throwing that number out there, but thankfully we've got people to hold them to account with the real data. But yeah, a really interesting one when we see so many people that have exited Victoria, but then Victoria is now, one of the most popular places for property. It just sort of goes to show the people that were in and around ready to exit just absolutely had enough. And the land tax impost has really kind of been priced in now, and it's helped Melbourne's sort of market to soften quite markedly to the point where the proposition is pretty good when it comes to affordability, household income versus asset prices. So it's definitely on the radar for investors.
I think also if you're buying one investment property in Victoria and it's a mid-range property, the land tax isn't that huge a differential to most other states. It's once you start to build up a bit of a portfolio. So, I'm sure savvy people look into that, understand that, and also see how Melbourne has underperformed for a period of time with a bit of stigma from the lockdowns and then, people leaving the state, less people work in the CBD, but, you've got to think it's probably found its level, and there's high migration numbers, particularly very high overseas migration numbers and a bunch of other factors. So, yeah, that's interesting, that 41%. For Melbourne, second highest was 26%.
To throw another thing out there, Dave, I think if we summarise it, we would say that investors have actively exited the market in a way that we haven't seen in the last couple of years. And with the question of how many properties did you sell in the past 12 months, 18% of investors sold more than 2 properties, 2 or 3 plus. So that's a big chunk, especially when we realise that only 42% of those sales were repurchased by investors. So we are definitely going to see some continued headwinds for rental affordability. We need that investor participation rate to increase. And we focus so much on first home buyers and getting them into the market. But as I saw very recently, in Brisbane at least, the price point underneath the cap for that 5% deposit without LMI is $1 million in Brisbane, and within the last month they've seen about a $50,000 increase in sale prices underneath that cap, with people just piling in. So again, we're kind of the
false
RBA's
economies.
the RBA's own modelling say that these home buyer grants roughly increase the costs for everybody to the same amount that it was worth for the people getting in. We're kicking the affordability can down the street. And when we talk about affordability, for decades it seems we're only talking about first home buyer affordability, but a third of people rent and they need to be housed. So we have to be considerate of the part to play that landlords have in Australian property and putting roofs over people's heads.
Yeah.
Yeah,
Agree.
100%.
I think it's for anyone who's interested in some of these stats and pouring through what the survey touched on. There's so many questions. It's a great survey. You can get all kinds of snippets about investor behaviour and attitudes and trends. One that I noted was asking people broadly about their property investment exit strategy. So, what's the end game here? And 16% say they're unsure at this stage, which is not a bad read. So 84% of people know what they want to do. 30% hold and never sell. 50% sell down some or all. And 4% live off the equity. Now, I thought that was pretty insightful because the property investment professionals of Australia, it's a really it's a large industry association with a lot of members and a lot of people that are really happy to have somewhere to call home as investors when they're wanting to be around like-minded peers. And I would have anticipated that more would have a hold and never sell kind of philosophy, but 50%, half want to sell down some or all. So just a bit of insight.
Yeah. It's interesting, isn't it, what people plan for their properties into retirement. It will be interesting with this, the higher number of investors selling. I just wonder how much of it's off the back of rates rising at the fastest rate they ever have risen and just hitting people unexpectedly. And now we've had rates start to fall. Less people will sell investment properties. It'll be interesting to see. And if there was a correlation historically when rates rise, we see more people sell investment properties.
Yeah.
But I don't know the answer to that. That's just, I just think it might be one of the major reasons, just on top of, some of the state-based legislation and complexity that's been added. But let's wrap it up there. That's been a really insightful episode, guys. But before we finish, let's go to our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
We've recently had the 21-22 ATO tax stats released, and yes, those years are out of date. That's the way that they're issued. But if we go to the prior year, we actually saw net negative gearing losses pretty much at zero due to the historically low interest rates. But very interesting in this survey to see that 56% are negatively geared, 16% are positive, are neutral, and 26% are positively geared. I find that number really, really interesting. Obviously, I would expect it to be a little bit more given the fact that interest rates have risen quite a bit in the next little while, but we should probably see an increase as the tax stats get closer to today in negatively geared values. So unfortunately, we're probably going to continue to have this perennial debate on negative gearing, and we can see from the survey itself that it's a very, very sensitive issue. Both capital gains tax and negative gearing is cited, both cited as reasons why people might dispose of their property. And we can't really afford to have more people exiting the market when we are seeing rents continue to increase. So that'll be an interesting one to watch.
I'm putting my PIPA board member hat on here. We've got a wonderful community of listeners, and if you would like to contribute next year to the survey, we will embed the links and encourage you to do so. Not only do you get to have your say, you'll be privy to all of the information that comes out of the survey among your industry peers. So do keep an ear out for that, and everybody's input makes it a stronger set of results.
How many people responded in total to the survey? Do you know?
I know last year we cracked over 1,000, and I'll have to get the final figure, but I believe it was of that magnitude.
Yeah. So it's a significant sum of people.
Yeah.
Yeah,
look, the
I
more
think
you
when they
get,
do election polls, they often don't have up. They have under 1,000 people.
yeah.
That's not really enough for statistical significance if we're sort of borrowing from statisticians and sample size and veracity of the data. I mean, whether that number was 1,000, 1,600, 2,000, it's not really enough. And I would encourage property investors to understand the role that PIPA has. I mean, there's the Property Investors Council of Australia, which represents landlords. PIPA is focused more at the professionals and the professional standards, but PIPA does a lot of heavy lifting when it comes to consultation on residential tenancy changes, consultation on the impact of policy changes around things like negative gearing, capital gains tax, and is firmly on the side of property investors in terms of the value that they bring. Of course, affordability matters to everybody, and it doesn't necessarily matter that, the three of us might not be sort of saving for our first home. We're a little bit later on down the track, but it matters to us from a society point of view. We need to be able to have affordable housing for people to live. We don't want to be in situations where there's places around the country where you can't get hospitality staff or childcare workers because their salary is just so minuscule compared to the local population in some of these blue chip areas. We do need to have a conversation about how we can house people in an affordable way so that they're not spending 40% of their household income on their housing.
Yeah, look, PIPA do a great job, and let's certainly make sure we share the survey with our listeners next year and keep bumping up the numbers so the quality of that data continues to be the best it possibly can be.
Yeah, awesome.
Just before we go to Dave, we sort of saw that Victoria was one of the more popular states to dispose of a property. It's also the most popular state of people that have bought in the last 12 months and are also looking. We've just in the last week crunched the numbers on the investors around Australia that come through our doors. And you probably remember that it was long-term average pre-land tax. Around about 16% of investors were purchasing in Victoria. You could probably say in the last 5 years. During land tax, that dropped into the single digits. We saw a mass exodus. Now we're actually seeing the proportion of investors purchasing in Victoria, you heard it here first, guys, at 32%, actually in first position by 1%. So Victoria is now the most popular state for our investors, and it's eclipsed Queensland, that has been the perennial kind of favourite, whereas Perth also, as a flash in the pan, came and beat Queensland for a period of time as well.
Oh, that's
That's
crazy.
really interesting insight. You should share that if you're not going to already as a press release. Share it with me and we'll quote you guys.
Let's do an app.
And we'll
Let's do
post
an
it.
app on
Yeah,
it.
and do an app on it. Yeah.
I got some
I've got
juicy
a question
new data
for you, Mike.
guys.
I'm looking at our read for October, and I was expecting Melbourne to have the biggest gains because it feels crazy here. Like every single weekend, auction results are setting a new record. But what I will say, that takes me back to a convo I had with you back in 2021, Mike, when we had that stamp duty 50% concession applied to all purchases under $1 million during lockdown or during COVID. We saw a lot of sales and a lot of price push in that sub $1 million mark. And you rang me and said, hey, what's going on with the Melbourne market? You've slipped back. But obviously, we're looking at median values. Now, I'm looking at the data for October, and Melbourne hasn't done what it feels like it should have done. It's only done 0.5% for 1 month, which is still significant. I mean, on $1 million property, it's a movement of $5,000, and you can't take that back. But we've had really strong gains on the middle segment of the market. So try and buy a house under $1 million. Those sales are just pushing really hard and running away. And I know markets in Melbourne that in the last 6 months, I could confidently say they've done at least 15%, and some have touched on 20% for houses. So data is really interesting. And when it's segmented into the different price points, that tells the true story. But I'm keen to know if your data captures the price points.
Yeah, well, we haven't necessarily segmented that down at the state level, but for 2025 up until September, the average purchase price that investors were spending on a house is actually $575,000, which is so incredibly low, right?
Yeah.
So, I mean, if the Victorian average house purchase price is anywhere close to that, then it will be dragging down the median, or at least that lower quartile will be seeing the lion's share of the transactions. So that is a consideration. And I suppose, like, I remember very vividly having that phone call with you saying, like, are you coming and moving somewhere nicer like New South Wales because your market's crashing? And you're like, no, I'm absolutely flat out. I'm just buying the cheapies. The same thing is happening because of this first home buyer stuff. So, for example, I was talking to a buyer's agent in Brisbane. The median price in Brisbane's in around $1 million now, right? But the cap for this 5% deposit is at $1 million, and they're just seeing a lot of transactions happen sub $1 million. So we might actually see, and I would love to see a journalist run this story because we'll smash it to smithereens. Brisbane may actually show some negative growth in the next little while, or the pace of growth could very possibly slow down because it's that lower quartile that maybe is seeing the majority of the transactions. I haven't seen the transaction data per quartile as yet, but there is a reasonable case to argue for that it's going to be that lower price point. So journalists may say, like, Brisbane market is off the boil, but it's just a function of that segmentation. And that'll be proof that you shouldn't always listen to the newspaper and what you read out there.
Not median house price data anyway.
No.
It's just one measure.
Big shout out to my journalist friends who are no longer wanting to answer my calls. But look, I think
gold
at
nugget
the end
ever.
of the day, yeah, we've just got to we value the truth, so we'll hold people to account on your behalf, dear listener.
But it's a really good point of how data can provide information, but not necessarily is the panacea for what you should be doing, what's happening in the market, what you've got to look underneath the hood and understand what's going on properly. And there's always part art, part science to every investment decision, whether it's property, shares, or whatever it might be. I was just trying to look up, because we're recording 1st of October, I was trying to find the September results for CoreLogic.
Yeah, they're out.
But I just couldn't
we've
quite
got 'em.
find them.
Yeah. You were saying October data, Kate.
Yeah, they came out 5 hours ago. And why don't we keep our powder dry? What do you reckon?
Keep our powder dry for the market update. Yeah.
Yeah.
So otherwise, we'll set fire to that.
Yeah.
All right, you better sign off, Dave.
All right.
I mean, how much of this finds its way into the episode is up to the god that is Jamie.
All right. Well, that's been another great episode, guys. Thanks for your hard work on the board at PIPA and for sharing this survey insights with all of us and our listeners.
Cheers, Kate.
Thanks,
See you
guys.
next week.
See you guys.